Welcome to the Explainer. Today, we're going to break down a really important accounting rule, one that basically acts as a reality check for companies. It's called International Accounting Standard 36, and it's all about making sure a company's balance sheet is, well, an honest one.
So let's just start with a really simple question. Think about it. If a company buys a factory for, say, $1 billion, does that mean it's still worth $1 billion 5 years later? Probably not, right? And that simple fact is exactly why IAS 36 is so important. All right, here's how we're going to tackle this. First, we'll define what we're even talking about with asset impairment. Then we'll look at the warning signs. After that, we'll get into the actual test, see what happens when an asset fails, and finally ask if there's any coming back from it. Let's do it. Okay, so what is the core problem here? At its heart, asset impairment is all about tackling a simple but pretty dangerous risk: the chance that a company's balance sheet just becomes a work of fiction, listing assets for way more than they're actually worth. You know, the standard's own objective says it perfectly. The whole point is to make sure a company's assets are carried at no more than their recoverable amount. To put that in plain English, this rule stops companies from pretending their assets are worth more than what they can realistically get back from them, either by using them or, selling them off. Now, companies don't have to test every single asset they own every single year. I mean, that would be a nightmare, right? Instead, the standard says, look, at the end of each reporting period, you need to be on the lookout for specific red flags, or what they call indications, that an asset might have lost some serious value.
And the standard basically groups these warning signs into two buckets. You've got external stuff, things happening outside the company, like some crazy new technology that suddenly makes your factory look ancient. Then you have internal factors, which could be as obvious as physical damage to a machine or something more subtle, like internal reports that show a part of the business just isn't performing. If these signs pop up, the alarm bells need to start ringing.
Okay, so a red flag has been raised. Now what? Well, now we get to the heart of the whole process, the impairment test itself. This is the mechanism for figuring out if all that smoke is actually coming from a real fire.
And the process is actually incredibly logical when you break it down. First, you assess if there's even a hint of a problem. If there is, you estimate the asset's real-world value. Then comes the most important step. You compare that true value to what's on the books. And finally, if there's a shortfall, you have to recognize the loss. Simple as that.
So, that comparison needs two key numbers. On one side, you have what's called the carrying amount. Just think of this as the asset's value according to the company's own records, what they say it's worth. And on the other side of the coin, you have the recoverable amount. Now, this isn't some historical number. This is the reality check. It's the best estimate of what that asset is truly worth in the real world today. And here's where a really crucial detail comes in. To figure out the recoverable amount, a company has to calculate two things. First, what they could get by selling the asset, and second, what they could earn by just keeping and using it. Now, the standard says they get to use the higher of those two numbers. It kind of gives the company the benefit of the doubt, letting them use the most optimistic, yet still realistic, value. So, the test is done. The book value has been put up against reality. But what happens when reality comes up short? This is what a company has to do when one of its assets is officially impaired. The math is super simple. If the carrying amount, what's on the books, is bigger than the recoverable amount you just figured out, well, that difference is the impairment loss. It means the asset is officially overvalued, and that overvaluation has to be corrected right now. And here's the kicker. This isn't just some accounting entry that gets buried somewhere. That impairment loss hits the books immediately as an expense. It flows right into the income statement and reduces the company's profit for the year. It has a real, tangible impact on the bottom line. But hey, things change, right? Business fortunes turn around. What if a market recovers or some new innovation makes that old factory valuable again? Can a company actually take back or reverse an impairment loss they recorded in the past? And the answer is yes, but with some pretty big strings attached. Paragraph 114 says that if the economic situation that caused the write-down has clearly and demonstrably improved, a reversal is allowed. But there's a ceiling. You can only write the value back up to what it would have been if the impairment had never happened in the first place. However, there is one very, very important type of asset where this whole idea of a reversal is strictly, absolutely forbidden. And this quote from paragraph 124 is a stone-cold rule in accounting. An impairment loss on goodwill can never be reversed. Goodwill, that fuzzy, intangible asset that represents things like brand reputation from a takeover, is a one-way street. Once you write it down, it's gone for good. Period.
So at the end of the day, IAS 36 is about so much more than just numbers. It's a system for forcing realism, transparency, and trust into financial reporting. It makes sure that what you're reading reflects economic reality, not just wishful thinking from the past. Which kind of leaves us with one final question to chew on. How does knowing about this enforced honesty change the way you read a company's financial story?